to the latest episode of Hugh Knows.
Yeah!
I'm here with Jonathan Bonk and yours truly, Mr. Hugh Hartzog. And if you've been paying attention to what's going on with mortgage rates lately, one thing that has been interesting for us, and we're going to break it down today, is how the inflation numbers are improving, but interest rates are not. So we're going to discuss that, and we're also going to look at what's going on in Houston because, as we always say, interest rates are national, but the market is local. And so that's what the whole point of this episode is about. We've got some really exciting stuff. If you're a realtor, you're going to want to pay close attention, obviously, to what's going on with rates, but more importantly, what's happening here in Houston and what the updated forecast is for the rest of the year. You're going to like it. But before we go any further, just have to say, as we always do, that this episode is just our personal opinions. So it does not reflect the opinions of our parent company, Network Funding, nor should you take this as investment advice. We are not here to give you investment advice, just our opinions on what's going on in the market. So, Hugh, let's break it down. What's happening?
Great. And yeah, just one thing to add is we're shooting this on a specific day, point in time, so on July 10th. So we're getting some new economic data out this week, so things could change very quickly as we know in the market. So just bear that in mind as you watch the content. So the first thing that we're going to jump into is interest rates, the good, the bad, and the ugly. So on this first slide, I'm basically showing what has happened with the 30-year fixed mortgage rate, so that's the blue line, since the beginning of this year. And unfortunately, over the past several weeks, we've seen rates go up. And there's been a couple of reasons for that, mainly having to do with strong economic data, or at least perceived strong economic data that's coming out related to the labor market and also related to inflation. So the last PCE, which is the Personal Consumption Expenditures Index, that came out at the end of last month, and that basically showed that inflation was falling, but not as quickly as the Fed would like. And so that kind of caused some upward pressure on mortgage rates. And then we've also seen some fairly strong labor reports. The ADP report beat expectations by almost double. And so the market's seeing that and saying, man, maybe the Fed is going to have to keep rates higher for longer, or maybe even continue to raise rates. So we've seen that rise over the past couple of weeks. So what do y'all think, guys?
Yeah, I mean, the chart that's up right now, if you're looking at it, shows that we're at 7%, give or take a quarter or not on the 30-year fix. And this is the third time we've gotten here in the last 12 months, if you're looking at the chart. And every single time, it's been short-lived. And so, not that I'm a betting man, but, I feel like what the Fed's doing right now is they're just trying to posture and get everyone to brace for higher rates for longer. And they might actually do that. But every time we get to 7%, it seems like we slowly come back down. So we'll have to see what happens in the coming weeks.
Yeah. I mean, honestly, I've been a little discouraged this month because we're seeing all of these good indicators as far as inflation goes, and our mindset was, as soon as we start to see these things happen, including the Fed pausing their rate hikes, we should start to then see mortgage rates improve. But really, it's been the exact opposite. We've seen these good indicators, and then rates just continue to get worse and worse again. And so it just kind of feels like we're in this loop of we think we're going to kind of break through and start really coming back down, and it's the opposite. And so that, to me, I'm excited about this episode because my forecast has been wrong, and so I'm excited to see why it's been wrong. Hopefully that helps some people understand what's happening.
You are in good company because basically the rest of the market was of your opinion, at least until about a month ago. And so on this next slide, I'm showing what the market's view of interest rates, of what the Fed would do with interest rates, is a month ago, which is in the blue line. So that's what the market was saying a month ago. And then the green line is what it is saying right now. The red line shows what the Fed has released on its dot plot, so their official projection of where they think they're going to put interest rates. And then those little markers show when the meeting dates are going to be for the Fed over the next year or so. And so basically what we've seen is we saw PCE data come out that didn't show inflation falling as much as we would like. And as we've seen the labor market continue to be tight, the market has basically shifted its view up versus a month ago. And so that's why we've started to see those interest rates slowly stepping up. And so we could see that on the last chart. But this is effectively what's going on. The market is aligning its view with what the Fed has been saying for a while now, and so the market has basically changed versus where it was about a month ago.
Yeah, I mean, I feel like the market has finally sobered up.
Yeah.
I know if you watch some of our prior episodes, we're talking about how the Fed's saying this, and then the market's kind of calling the bluff, like, oh, you're not really going to do that, and that kind of kept the rates down because rates are based on what happens in the market. The federal funds rate does not set what happens with mortgage rates. What happens in the market does, with mortgage-backed securities and the secondary market and bond yields and all that. And so the market was calling the Fed's bluff, and I think now the market's like, all right, we're going to sober up and get in line with you.
Mm-hmm.
And so that's kind of how we've seen things peak up the last couple of weeks as far as rates go.
Right. And so basically what the Fed, what the market is saying the Fed is going to do right now is that we should see one more rate increase this year and then see the Fed hold that steady through the end of this year and then start to see rates come down in the first half of 2024. So that's the view now. And of course, that's a little bit more a higher view than what was previously baked into the pricing.
And that's all predicated, right, Austin, on something unexpected not happening.
That's right.
What happens if a Fortune 500 company goes belly up, or a bank failure happens,
or a coup d'etat in Russia?
Right.
Yeah.
Right.
Everything going on.
Yeah. So I mean, the longer rates are higher, it increases the likelihood that you're going to see cracks appear in the financial system. So it increases the risk that you might see another bank failure. So that is something to keep into consideration, that this view doesn't really have that some sort of unforeseen event baked in. If the unforeseen event happened, like a big bank failure, then that would obviously change the market's view. Yeah. So let's jump into the next section, which is talking about the inflation impasse. And this is really what the Fed is. This is what they're grappling with, right?
Yeah.
So they're trying to get inflation under control, and the main thing that they see as inhibiting that is a really tight labor market. So,
well, I think too, Hugh, from a macroeconomic standpoint, what drives GDP in America? The consumer, right?
Yeah.
We're a consumer-oriented economy, and so they want the economy to slow down. The only way to do that is to slow down the consumer.
Right.
And what's number one way to slow down the consumer?
Slow down the jobs.
No job, no income,
That's
no consuming anything,
That's
right?
Yeah. So that's what they're trying to do. They don't want people to lose jobs, but they also don't want people to suffer the effects of of inflation that's high, because they know that's also an issue. So what I'm showing right here on the chart is two different data series. I'm showing the job openings in the United States, and that's going to be in the blue dashed line, and then I'm showing the number of unemployed people, and that's going to be in the red dotted line. And then the difference between those two is in the blue shaded area. So you can see that prior to COVID, there were essentially more job openings than there were people that were looking for jobs or the unemployed. And so that put some upward pressure on wages, not too much, but a little bit, because there's a little bit of a gap. And then once COVID hits, unemployment goes way up. So the unemployed is way higher than the number of job openings. And then as the economy moves past COVID, we see that reverse again. And now we're in the situation where we have way more job openings than we have people looking for jobs. And so it's sort of economics 101. If you have more demand, then you have supply available. That's going to put upward pressure on prices. In this case, the price is wages or compensation. And so the gap between job openings and the people looking for jobs is really what's keeping inflation higher than what the Fed wants to see.
Right. Yeah, and I think this is why this is maybe arguably the number one reason for why mortgage rates have not improved. So seeing inflation coming down, yeah, that's great. But then seeing that we still have a roaring job market,
right?
It's the Fed's trying to take that all into consideration, not just the cost of goods.
Right.
So yeah, then is it on this slide that we're talking about the recent jobs report?
We can.
Yeah, jump into it.
Okay.
I think that was
So I mean, like one of the things specifically about the labor market, and this came out last week, was the ADP jobs report, and this basically showed that jobs added beat expectations by double. So the market saw that number and they're like, wow, the labor market is really, really tight. It continues to be very, very strong. That means the Fed is unlikely to lower rates or cut rates or keep them the same. They're probably going to increase rates. But then 2 days later, you had the non-farm payroll statistics come out,
Right.
and that actually showed that the U.S. added a lot fewer jobs than what most economists were expecting. So you have a little bit,
and it adjusted down for April.
That's
and
right.
May, and
That's
then the
right.
June numbers were way down.
That's right.
So you got like one story saying like Fed's doing what they need to do, another story like what is the Fed doing?
right,
They're destroying demand within the labor market. So
right,
both of those data sets are very conflicting.
Yeah, that's what I was gonna say. Is like help me reconcile that, like, because
So to me, yeah, ADP was the private payroll,
Right.
right? And so you have Paychex, you have Paycom, you have ADP, you have a lot of different payroll systems, but ADP is probably the biggest in the country, so they have a really good pulse. But my whole thought is all these people are losing jobs, making 100 grand, 200 grand at all these tech companies, and I'm like, so they sign up for a DoorDash or Uber or get some side job, but now they get added as a payroll, and it's like they might be working 20 hours a week, might be part-time.
right.
And so it's like just because we added more, that's why I think wage growth is more important
Right.
than actual unemployed, job openings, and all that story. It's like where are wages heading? If the average American is making less and less, then that means the Fed is doing a good job. But then they see more jobs added ADP, they freak out. And I was like, yeah, but someone got laid off. I mean, we've all seen it in San Fran, Seattle,
Right.
even here
Right.
in Austin. And it's like just because they took a part-time job doesn't mean like, okay, like ADP through the roof.
Right.
And it's like, well, how much is that person
Yeah, it's
making?
jobs added. It's
Yeah.
not what type of job. Is it a full-time?
Exactly.
Is it contract? Is it salary?
So that's the big missing piece. And then the non-farm payroll, which I think is more accurate what's going on. That includes government jobs and hospitals and education
Right.
and all of that stuff, right? I mean, I think the number one employer in Texas is the teachers,
Right.
whatever the Texas Education Department is. That's the number one employer. So it's like that data is probably more impactful and more accurate
Right.
and more real time than the private payroll stuff.
Right.
And so that one came in way less.
Right.
So,
Yeah, like 50 or 60,000 jobs less than what they were
Yeah.
expecting. So definitely a little bit of contradictory data depending on what you're looking at. But I think that leads us perfectly into our next slide, which is looking at the actual inflation. So the Fed's preferred measure of inflation is the Personal Consumption Expenditures Index, which effectively looks at how much on average people are earning versus how much they're spending. So
Right.
it's sort of the earnings versus the spending, and that's how they get that. And the Fed looks at that measure very closely, and it hasn't been falling as quickly as we would like. So if you look at the screen right now, I'm showing the headline PCE number and then the core PCE number, and those are in the dark blue dash line and then the dotted light blue line, respectively. And the dotted light blue line is the core, and that has not been falling as quickly as the Fed would like. It's been fairly flat this year. It jumped up a little bit in April, came back down in May. But that's what the Fed is really looking at, and they're not seeing enough progress on that. But the Federal Reserve Bank in New York has an alternate measure of inflation that they call the multivariate core. And what this measure of inflation does is it takes into consideration a few different data sets that are much more timely than the PCE does. So the PCE is relying on some lagged data, sometimes six months ago. And so this multivariate core trend, this different measure of inflation, tries to take into account more recent data. And what that is showing, and that's in the green line on the screen right now, that's showing that inflation is actually lower, both in the headline and the PCE number, at least for the last month. And so that's very encouraging. And we need to take into consideration that there are different measures of inflation. CPI is a measure of inflation. The PCE is a measure of inflation, and this is another measure of inflation. They give us different flavors of the data, and they're kind of telling us slightly different things, but we need to be able to take into sort of a wide view of all of the different sorts of data sets that we have. And this, to me, is very encouraging, showing that, based on more recent data, we've made more progress in inflation than the top line PCE number would indicate.
Right. And so one way I like to think about this is looking at rent, right? So the PCE core is looking at rent averaged out, right? And what's the average amount of rent that everybody's paying right now? But the problem with that is people's leases are typically 12-month long leases. And so you've got all this rent data that's in there that's lagging because these are leases that were signed last year when rents were super high. Yeah, it's slowly starting to trickle back down because we're blending in the new stuff.
Yeah, but what are people signing up for right now?
Right, whereas the MCT data is looking at what's happening like right now. Right. So the average of, okay, what happened this month? Where are rents? And it's showing that things are starting to really come down. But of course, if you're blending that out over 6 or 12 months, which leases are, then you're going to have a higher core number. And so, yeah, I think that both are important because, yes, people are actually still spending that. But we're seeing where things are heading.
Where are we going? And that's really what the Fed is trying to address.
Yeah, and I think that's important. And one thing we had a great conversation before we started recording about the PCE versus the CPI. Right. And we were talking about how the CPI is looking at the cost of inflation, like what are goods actually costing, whereas the PCE is looking at how people are spending, you know. And so we're having a good discussion about why we think the Fed is focused on that. Hugh, recap that.
Well, yeah, I mean, they want to understand not just are prices increasing, but are they increasing relative to what people are earning? And so that's what the PCE index is doing. Is they're looking, okay, how much people are spending versus how much they're earning. And so it gives you that ratio. And so that takes into consideration the earning part because, yes, while prices might be increasing, and that's what you would see in the CPI, if you're seeing wage growth increase faster, then maybe that's not so bad for the consumer, right? Because then they're earning more relative to the price increases. So that's why the Fed likes the PCE and focuses on the PCE. But this MCT version, like you said, takes into consideration data that's more recent and then gives us a better view of what's about to happen.
Does the MCT take into consideration the earnings at all? The way the PCE is looking at what people are spending versus what they're earning?
I don't know.
We'll get back to you.
We'll cut that out. There was a pause. Cool. All right. So, but that was it for that section. Let's jump into the next section and let's talk a little bit about Houston, what we're expecting for the second half of this year in H2 2023. So, on display on the chart on the left, I'm showing Houston home prices, and this is for single-family residence, townhomes, and condos since 2013. Okay, so
look at that trend.
Yeah, it's just biggest thing to know is it's a mixed bag right here, right? But directionally, things in Houston have been heading up and up and up.
Yes, definitely some variability. It's just not a straight line up, but the general trend is obviously upward. And then the second thing that I want to point out on the chart on the left, again, this is average home prices in Houston since 2013, is that, and you'll see this on the screen, is that there's sort of a cyclical or seasonal nature to home prices in Houston. And I think a lot of realtors would definitely...
Austin, what happens in July in Houston?
We all go on vacation.
It's 110
we escape the heat. We go to Colorado.
That's right. It's 110 degrees in Houston. So guess what people do? They're not looking at houses. They're out of town. They're at a lake house. They're seeing family in Michigan.
We're looking at mountains.
They're in mountains. They're not in Houston. It's so hot. Your kid's out of school. We have kids. I mean, having them locked up in a house because it's so hot all day is crazy for everybody. So it's like, let's pack up and get out of town. And so a lot of people are away. So it's hard to sell real estate when people are away.
That's right. Mm-hmm. So, I mean, we see prices increasing in the spring up until about June. And then we see sort of a slump during the summer, post-summer months. And then typically we see a little jump in December, what we like to call the December pop. But you'll see I'm putting these black arrows on the screen that you can see that sort of cyclical or seasonal pattern to the price data. And we've seen that pretty consistently, obviously, with 2020 and 2021. Mm-hmm. That pattern isn't as noticeable. It's still there if you look at the data, but it's not as noticeable as in other years because, there's some things going on in 21 and 2022.
The unicorn years.
Unicorn years.
You just take it out the data set if you can.
So I want to focus in on 2022. So now on the screen, you should see the chart on the right. So honing in on 2022, basically we had the typical sort of build up in the summer months for prices. And then, of course, we know what was happening last year, especially after Q2. Interest rates were rising quickly, and that really put downward pressure on sales and home prices, even in Houston. Yeah. And one thing that's noticeable here, as opposed to most years, we did not have a pop in December in 2022. And then I'm showing on the chart on the right, the dark blue line is the history thus far for 2023. And so you've seen, again, that typical pattern in history. And then I'm forecasting what I'm expecting to happen for home prices in Houston. Of course, you can see home prices kind of a proxy for demand, but basically expecting that seasonal pattern where you start to see home prices decline post-June into July. But as opposed to last year, and this actually matches up with the view of interest rates, we are expecting to see prices pop back up in December in line with that seasonal trend. So I'm using historic growth and sort of seasonality factors to get my forecast. And so that's why you start to see prices increase towards the end of the year. And of course, it's towards the end of the year when the market is expecting the Fed to start cutting rates. So that would make sense that we would start to see prices pop up then, and also gives us a little bit of a better view going into 2024.
How much of an impact do you think the homestead exemption has on that pop? Because previously that was part of the angle, I know, for realtors heading into the final month of the year, like buy now so you can file for your homestead in January. Whereas, if we wait until January, then you're gonna have to wait a whole nother year to file. Obviously,
now it's
Texas changed that, and you can get your property tax homesteaded as soon as you own the property. You don't have to wait until the following calendar year. Do you think that's going to have, how much of an impact do you think that has on the December pop? Is that a non-issue, or?
I mean, I think that you see the December pop in other states that don't have the homestead exemption.
Okay.
So
yeah. I was going to say like less than 10% probably.
Yeah. I mean, I'm sure it has effect. I haven't quantified what that effect would be, but you still see this. It's more of like people wanting to get into their houses before Christmas and the New Year,
right? 100%.
As opposed to necessarily homestead exemption.
Well, I think too, and sellers are ready to get rid of the house in November, December, and your tax
year. So there are other factors, not just the homestead. But I think all things equal, changing the homestead would decrease somebody's incentive to close in December. So it probably have a little bit of a negative impact on that.
Yeah, slight impact on it. But yeah, it's encouraging to see that things seem to be returning to a more normal pattern.
Right. Yeah.
Yeah, and if you're a realtor and new to the business and you didn't feel a pop in 2022, you're like, well, what happened in 2022? I think a lot of people that were planning to buy in 2022 in October, in November, December, we're working with smart realtors and working with smart lenders. Like, we need to get you in house earlier, and so a lot of that volume just got moved into the summer instead of Q4. Mm-hmm. And then in November is kind of where we hit that peak of 7.25% or 7.5%. And it was like, all right, we were really getting up there, and that might have had some people put a break and wait till the next year to buy, and so that's likely why we didn't have that pop last year.
I think another reason why we didn't have the pop last year is also because the consumer was so shocked by the rapid increase in rates, and they're like, we're going to wait until rates come back down.
Right.
And I remember screaming at everybody as we were skiing down the right side of that blue mountain, like, y'all need to be buying now, because we're going to click over into the spring, and right now things are softening. It's a great time to negotiate. We're going to get to spring of 23, and home values are going to launch. And if interest rates start improving, it's going to be even worse. And that's literally what happened.
Yeah, I mean, things did improve in the spring this year in 23, right?
Yeah, especially relative to the second half of last year. So if you were like, oh, I'm going to wait because interest rates are too high, and then you're like, okay, now in the spring I'm going to buy. It's like, well, interest rates haven't changed at all. Mm-hmm. Actually, since November to now, they're basically flat. Yeah. But now home prices are above where they were in the second half of last year.
Right.
Yeah.
So,
right. I think it's dangerous to be a sheep in this market. Sheep follow each other.
Yeah.
And it's dangerous to do that. I think what you want to do is you want to be sober-minded. If you're a home buyer right now, or you're thinking about being a home buyer, you're trying to time the market to time it when it's the good time to buy with everybody else. I think you need to zoom out and look at data like this and go, where's the sweet spot to buy? I mean, looking at this chart, it tells me the sweet time to buy is late summer, early fall.
Right.
That's probably going to be my best
back
window
to school
for purchasing and being able to negotiate something. If I wait any longer, I don't want to wait for what happened in Q4 of last year to happen in this Q4, because the projections are showing the opposite. Right? Like, you want to be, if you're trying to time the market, like, you don't want to wait much longer.
Right. Also, I mean, if you consider the fact that, yes, the market is expecting the Fed to start cutting the rates by the end of this year, beginning of 2024, but we're not talking about massive cuts, right? We're talking about a slow step down. So with that, interest rates are not likely to be back in the threes.
They're not going to plummet.
Right, they're not going to plummet. So again, it just, you're basically the interest rates aren't going to move that much. What is going to change are prices, and especially in our forecast, we're expecting prices to jump up by the end of the year. So,
and as those rates come down, pushes more people into
I
that
think
price
especially
range.
if we get below 6%. I think that 6% is a threshold for a lot of people. And if we get below 6%, then it's just going to be sort of almost a repeat of 21, 2022 because of the low inventory situation. You have people it becomes affordable for them to get in a house, and then multiple offer situation. I mean, every deal that I'm doing right now is a multiple offer situation anyway. So if rates were just down by down to 6%, just have a whole huge number of borrowers that just became qualified to purchase.
Well, and sellers are willing to put their house on the market at 6%.
Yeah.
Inventory is a big piece. I know we said that a lot in this podcast, like 2 months inventory, 2 months inventory. Maybe we'll get to 3 months if people put their house on the market, but that's not going to happen until we get to 6% interest rates.
Yep.
And then just to round out this section, so this is basically very similar chart to what I'm showing last time. This is the unit sales. So the stacked bars are just the different price points for the unit sales, and then the green line just shows the total. But you can essentially see that very seasonal pattern. You see sales increasing up to around June, and then they typically decrease, but then you do sort of have that December pop, at least in unit sales. So again, we didn't see that in 2022. We are expecting that in 2023.
Yeah, so if you're a realtor out there, do not go to sleep on 2023. I mean, get organized, get on top of your database. Last time we did this, we had Rich, our EVP, with us, and he had a great message about getting your database, putting an event together, just something to get in front of your people with video, with email, with live events, because I think we're going to have a healthy Q4. And you don't want to call it quits on the year yet. There's a lot of the houses to be sold still.
No. So to sum this up, I was discouraged looking at how rates have not come down following inflation. Really thought that as inflation got better, rates would come down, and that would give us the evidence we need to anticipate a strong second half of 2023. Well, just because rates haven't come down does not mean our outlook for the second half of 2023 has changed. And so looking at this helps show that things are actually doing exactly what we anticipated, even without rates coming down. So imagine what that's going to look like as rates do come down. Probably not until 24 at this point, but still a phenomenal outlook for 2023. At the branch level, we're outpacing our leads and apps so far in July compared to what we did in June and May. And that's just crazy because that should not be happening with interest rates doing what they're doing. Right? We should be seeing applications and leads going down. They're going up. And so if you're a realtor, you should be encouraged by that. And if you're at home, if you're thinking about buying, I think you really need to pay attention to these charts because waiting literally just means that it's going to get more expensive.
Yeah, I think psychologically rates rose very quickly last year, and so borrowers were hesitant to jump in the market. Psychologically, they've gotten used to it. The rates are now higher, and now the market's not signaling that rates are about to fall. So people are used to the rates, and they don't think that they're going to fall. So what does that leave you with? It's like, well, I got to live my life and make these decisions. So,
got to move forward.
Yeah.
Yep.
All right. Well, with that, we're going to leave off with this episode of Hugh Knows. Thanks for tuning in. We hope you catch us next time.
Peace. Adios.